Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends, just trying to make you a little money. My job is not just to educate, but to entertain, to teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. As the market gets weighed down by a flood of new tariff announcements, Dow slipping 279 points, S&P declining 0.33%, Nasdaq dipping 0.22%. We have to remember that stocks are holding up incredibly well versus what you might have expected a few months ago. At these levels, the market remains pretty overbought. I don't like that. But all of the new tariff threats barely dragged us down today. What we're seeing here is resilience, something that stems from tremendous demand for stocks for individual investors, which is something we share with an assembled crowd of CNBC Investing Club members in our annual meeting earlier today. The individual investor, amazingly, is so far undeterred by the harsh words and the tariff noose tightening that has now become commonplace. So with that in mind, why don't we check out what's on tap for next week? Remember, we're headed right into earnings season. On Monday, though, we'll have to sit through those new tariffs and penalties in another half dozen sovereign states. Always intrigued by how few countries seem to understand that it might be actually worth it to cut a deal now versus later. There'll be no doubt. And look, we're going to have new tariffs to study as the White House never sleeps. And we expect to hear something draconian about Russia. Whatever draconian counts as these days, it usually affects the oil market. I think oil is going lower. Tuesday, it starts. And are you ready for it? Earnings season in full swing with the financials starting things off as always. Hey, they were terrific last time around, but the economy's got a little weaker since so we're going to have to hear if there's any pickup in loan losses or slowdown in spending. The star of the show is always J.P. Morgan, and it's Jamie Dimon, it's the CEO. Been there since 2006 now. But I care tremendously, actually, about charitable trust holding Wells Fargo. Now that their asset cap problems are behind them, who knows how high CEO Charlie Scharf can take an unfettered Wells. One thing's for certain, it doesn't matter what CEO Jane Fraser says at Citigroup, everyone's going to raise price targets and praise the bank anyway. Yet, you know what the most exciting story might be? I think it might be BlackRock. Yes, the stock that caught fire recently, even after many investors had lost faith in it. That never made sense to me. BlackRock's the largest asset repository in the world. And has a new infrastructure component that I sure wish I could get a piece of, but it's only for 401ks. I bet CEO Larry Fink will tell a very positive story, more than justifying the stock's recent breakout. On Tuesday morning, we get this consumer price index report. Now, I know the president thinks it's time for the Fed to cut rates, but the Fed wants to wait to see. Look, they got to ensure that inflation won't make a comeback. It can't. The CPI number might be fodder for the Fed to stand pat, as we're only just beginning to see the impact of the tariffs. Wednesday, we hear from the two big investment banks, Goldman Sachs and Morgan Stanley. I think both will have terrific numbers and even better stories now that the mergers and acquisition business has exploded and the IPO market's warm, bordering on hot. What a change from even 2 months ago. And these two companies are going to reap outsized benefits. I like them both. My charitable trust owns Goldman Sachs, my alma mater from the 80s. Next, we know the semiconductors have become the hottest group in the market as the torch has been passed from software to hardware. Will that extend to ASML, the Dutch semiconductor capital equipment company, with an effective monopoly on its stage of the supply chain? We could be in for another round of semi-buying if the numbers from this one are good. Let me ask you something. Why is Bank of America stock still just selling at 13 times earnings? The franchise has been putting up consistently terrific earnings. Brian Moynihan's doing a great job. I think the stock's cheap because of the relentless selling from Berkshire Hathaway. One day, Berkshire will finish selling. And when that happens, you'll be paying a much higher price to earnings multiple for this fine bank. My advice, don't wait for them to finish. It'll be a good quarter. Johnson & Johnson kicks off pharma earnings season on Wednesday, and I think once again the company will not be rewarded for its consistency or its originality because there's still the sword of the talc lawsuits hanging over it. I don't mind J&J fighting the plaintiff's part, but it sure puts a damper on the stock. Thursday morning, we find out about retail sales. Now, I am very concerned about a slowdown in retail as the uncertainty of Washington seeps into Main Street. I suspect that weak numbers have already started. Then one of my absolute favorite companies, medical device maker Abbott Labs, reports. And I always like to tell you which companies tend to be misinterpreted in a negative way during the earnings season. Abbott's a textbook example. It bothers me, but there are always sellers who claim to be disappointed. So if you don't own any Abbott, may I suggest that you wait to see the numbers, wait for the stock's opening, wait for the sellers to appear. Patience is a virtue with ABT. If you want to know a stock that's too cheap relative to its growth rate, but nobody talks about it anymore, why don't you check out the stock of PepsiCo? It trades at a astounding low 17 times earnings. I mean, what gives? Well, how about GLP-1 drugs? How about RFK Jr. at Health and Human Services, who despises junk food, even as he seems to embrace junk science? How about the desire to stay healthy? All these have weighed on PepsiCo stock. Of course, don't forget they own Frito-Lay. Maybe it's finally overdone. I don't know. It's a tough industry all of a sudden. After the close, we're treated to the most delightful of conference calls, Netflix. First thing. I have a dearth of things to watch right now. It's really starting to bug me. So I'm going to be listening to the conference call in part because they talk about all the great overseas programming. I get some terrific ideas of what to watch when I get home that night. The bar is very high for Netflix, though, which will have to tell us how their ad tier's going, how Squid Game did, and how NFL Christmas streaming football advertising's looking. If Netflix doesn't deliver an outstanding number, though, I got to tell you, there'll be an awful lot of downside. We have so many price target boosts, even two today. I'd be a little nervous, even as I expect a good quarter. Then on Friday, there's American Express, which is another stock that tends to sell off when it reports, no matter how good the numbers are. That's why I always tell you to wait until the selling subsides if you want in. This time so different. I don't think what the sellers, I don't know what they're thinking about the sellers of American Express. They've been wrong for 150 points. Look at that stock. Listen to the call. This company is a unique, beloved product that young people cherish. What's not to like? Steve Squeri, CEO, one of the great ones. Well, he'll have a terrific call, and he will, you know what? He will tell us about why American Express card has now become not a product of a different era, our parents' era, but a product of everyone. Everyone wants to think it's prized. That stock's going higher. Now, the industrials have been on fire. The part of this broadened out bull market, and one of my absolute favorites is 3M. Which is beginning to remind me of the old 3M, where the question was simply how big the beat will be. CEO Bill Brown is crushing it. And this one's been greeted with buying, both before and after the conference call. Finally, don't say I didn't tell you so. We've been championing Charles Schwab from the days when the doubters cast aspersions on the balance sheet. That was 25 points ago. They've been silent of late. But I think the short sellers like to come out and color the opening of trading when Schwab opens. I say be very careful before you do some buying. The bottom line. Once we process the new tariffs, we've got a ton of earnings reports coming next week. So you better keep your eyes open. And don't forget that Abbott Labs, American Express, and Charles Schwab are likely to sell off regardless, even if their quarters are spectacular. Because that's just how those stocks trade. Let's start the question with George in California. George.
Yeah, hi, Jim. Am I too late to jump in PLTR, Palantir? It's run
okay,
up a
Palantir,
lot.
when it was at 50, I said it was going to 100. When it got to 100, I said it's going to 200. So in that sense, the momentum is still with you, and it is not too late. Now, does it deserve that? These guys talk a big game. It's a meme stock, okay? Like Robinhood, it's a meme stock. The memesters won't let the stock come in. It's not a good reason to buy, but I'm telling you where it's going. David in New York. David.
Hey, Jim, thanks for taking my call. Appreciate it. I was just calling about Pfizer, and I've held on to it for a while. I think a few years ago or a year ago or so you may have recommended it. And it hasn't really gone anywhere. It's still got a really nice dividend yield, about 7%. And, just technically, it looks like it's a good spot to buy it. But, it's not really going anywhere, so I was just curious what you thought.
Okay, well, I've not been recommending. My stock in the pharma business is Lilly, and the med equipment is Abbott. I do think that Pfizer is an inexpensive stock. They have to have some sort of catalyst. They have to prove that they have some new cancer formulations with Seagen. If they don't, you're just going to be marking time, picking up that 6 3/4 dividend. That is what will happen. How about we go to Carol in California? Carol.
Booyah, Jim.
Booyah.
So, Jim, I'm calling from Los Angeles, as you know, and I've got a question about a stock my husband bought during the pandemic that turned out to be a big win for us. So,
that stock
hello?
is? Yes. Just help you.
So
What stock
GE. It's
GE's fabulous. GE's fabulous. And I want you to hold it. Now, I mean, look, the temptation would be to cut some off because they just had a giant move. If you want to trim a little, that's fine. But I think that Larry Culp is going to tell a great story. It doesn't mean it can't come down. The stock is up in a straight line for up 53%. So any stock can be vulnerable, but I think it is one of the best in the book. Hey, twofer, I really like Boeing, too. I think Boeing seems like a very solid buy right here. All right, listen. Once we got through the latest tariff news, earnings season starts in earnest, so make sure to keep your eyes on the prize. On Mad Money tonight, Capital One completed its acquisition of Discover in May, and I'm running through the reasons why its shares could be headed higher, maybe much higher in the months ahead. Then, is now the time to try Contour brands on for size? I'm breaking down why I think the parent company of Wrangler and Cramer family fave Helly Hansen is a winner right here at these levels. And we held our Investing Club annual meeting earlier today, and we had so many fantastic questions from our club members that we decided to answer some more of them tonight. You don't want to miss it. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Whenever the average is near their all-time highs, even if today's pullback, all sorts of people come out of the woodwork to claim that great stocks have become overvalued. But sometimes these stocks have a lot more room to run. Take Capital One Financial, the bank with a huge credit card business that we own for the Charitable Trust, which you can join by, you can follow along by joining the CNBC Investing Club. Now, since we first bought this one for the trust on March 6th, we're already up over 28%, but we're sticking with it. Why? Because I think it's got a tremendous growth story. It's not done anywhere near here. The recent run is all about Capital One's acquisition of Discover Financial in an all-stock deal valued at $35.3 billion. Capital One's always been a major credit card issuer, but buying Discover gives them one of the four major payment networks, right alongside Visa, MasterCard, and American Express. We know all those three are great stocks. What makes Discover even more unique is that, like American Express, it both issues its own cards and processes payments. Visa and MasterCard don't operate that way. They simply collect little tolls for running their own payment networks, and they don't take any credit risk, which is good. In simple terms, this acquisition gives Capital One ownership of the Discover Global Network, allowing them to scale up to become a truly global payments platform. It also helps them reduce the reliance on MasterCard and Visa because now they have a payment network of their own and can collect transaction fees directly. By the way, this is another reason why I was so hostile to the Biden administration's antitrust regulators. They reflexively oppose virtually every merger, but sometimes allowing these deals creates new competition. Discover on its own could never really go toe-to-toe with Visa, MasterCard, or American Express, but Discover combined with Capital One, that's a different story. As the storied CEO Richard Fairbank explains it, quote, "We have always had a belief that the holy grail is to be able to be an issuer with one's own network so that one can deal directly with merchants and from merchants to consumers. It's all part of one comprehensive relationship," end quote. That's huge. But it's not the only reason why I love this acquisition. There's a lot more going on here. For starters, Capital One expects to realize $1.5 billion in cost synergies from this deal in 2027. They see another $1.2 billion in network synergies, partly from lowering payments to third-party credit card providers, partly from shifting Capital One debit and credit card purchase volume away from Visa and MasterCard and onto the Discover network. All told, management believes this deal is going to boost their earnings per share by 15% once we get to 2027. And that is substantial. I mean, this is a bank. You usually don't get that kind of growth. The Discover deal also creates new opportunities for Capital One on the international front. This is something that several bullish analysts have pointed out. Just this past Tuesday, TD Cowen upgraded Capital One, noting, quote, "While Discover as a standalone company had mixed results growing international acceptance of its network, we believe that could be different under COF," end quote. The analyst pointed to Capital One's strong track record of execution and its willingness to invest with a long-term mindset, citing the company's investments in its transaction card franchise and multi-year commitment to better technology. That's something they know a lot better than almost every bank. The Callan upgrade also highlights another positive aspect of the deal. Capital One may be able to offer more rewards for checking accounts now that they have access to unregulated debit interchange. Basically, Capital One can now earn more money each time a customer swipes their debit card because Discover's network isn't subject to the government fee caps that apply to banks. As a result, these guys can make more money, allowing them to offer debit card rewards, which could help them lure away depositors from competition because most banking competitors can't do this stuff. I know it's little, but these things add up. Most major banks eliminated debit rewards after the implementation of Dodd-Frank Act in 2010. That was an attempt to rein in the industry after the financial crisis. So this one gives Capital One a major advantage. And look, Capital One it's already got great at attracting bigger spenders to its credit cards with an array of enticing perks, everything from cash back and exclusive ticket or reservation access to shopping discounts, and of course travel benefits like TSA PreCheck credits and travel miles bonuses. There's a clear emphasis on travel perks, and one of the most valuable is the airport lounge. Let's face it, nobody can afford to miss their flight, and most of us usually have a lot of time to kill at the gate before we board the plane. And with airlines now boarding what feels like 80% of the plane in Group 7, that wait can feel a lot longer. After this merger, the combined company is the largest credit card company as measured by outstanding customer balances, giving it the scale to invest more heavily in these premium perks, meaning they can run circles around the competition. Sure, those airport lounges are expensive, but Capital One already runs commercials with Taylor Swift, so they're not afraid to open up their wallets. All of these synergies and enhanced revenue streams could ultimately lead to additional returns of capital to shareholders as well. And an analysis done by Truist last month estimated that Capital One has $15 billion in excess capital, equivalent to roughly 11% of the company's market cap. While some of that capital will be reinvested in the business, Wells Fargo published a report earlier this month predicting a $7 to $10 billion buyback announcement coming real soon. The banks are lining up in favor of this one. Keep in mind, Capital One's management still plans to complete an internal review of Discover in the second half of the year, which will provide a clearer picture of its capital needs and how much it can ultimately afford to spend on buybacks. Once that happens, though, they might decide to be a very generous buyer of their stock. The Wells Fargo note also expressed optimism that share repurchases could remain elevated, given that Capital One's currently in terrific shape. Delinquencies are trending lower, while the strength in net interest income continues, both positive signs for Capital One's balance sheet and its cash flow. Plus, when it comes to the impact tariffs are having on consumer spending habits, CEO Richard Fairbank noted at a recent conference call, quote, "We just don't see an effect," end quote. Put it all together, and it's easy to see how Capital One stock could keep being rewarded with a higher price-to-earnings multiple. Right now, the stock sells for just 11 times next year's earnings estimates, which makes it incredibly cheap versus American Express at 20 times earnings. I use Amex because it's the closest comparison now that the Discover deal is closed. Visa and MasterCard have even higher multiples. So here's the bottom line on this stock that, even though I know it's about nitty-gritty, but it is very exciting for me. Capital One stock has already had a major run this year, but that's because the Discover acquisition is incredibly positive. So I'm betting the stock has a lot more room to run. Even though the stock's within spitting distance of its all-time high, listen to me. I think it's still way too cheap here at a mere 11 times next year's earnings, and I think it is poised to have multiple years of outstanding growth. Mad Money is back after the break.
Coming up, can investors wrangle a profit out of Contour Brands? Cramer's digging into the apparel company and giving you his take next.
It's time to buy Contour Brands, best known as the parent company of Wrangler and Lee Jeans, although it recently acquired Helly Hansen, a terrific outdoor apparel brand known as Helly R on the severed floor of the Cramer household. I've been mulling on this one for a while, but after that last great quarter from Levi's last night, remember we had Michelle Goss on the show, I'm ready to pull the trigger. Now, Contour Brands isn't exactly a new idea. This company was spun out of VF Corp in 2019. Largely because VF Corp wanted to get rid of its slow-growing denim brands to focus on Vans and North Face. But since then, VF Corp's business has fallen off a cliff, and Contour Brands has caught fire, climbing from around $13 at the COVID lows all the way to $67 and change today, and it was in the mid-90s earlier this year. How did Contour pull this off? A lot of it's because there's a big comeback in the denim space over the past few years. Some of it's because of cost cuts and a multi-year self-help initiative, and some of it simply comes down to terrific execution. But after that great multi-year rally, Kontoor had a major pullback earlier this year as we started learning about President Trump's tariffs. All the apparel stocks sold off on that. The stock got a little pop in late February when they announced the $900 million Helly Hansen acquisition, and that was a steal. But within a week, Kontoor reported an okay quarter with a cautious full-year forecast, and the stock fell 20% over the next 2 days. It kept falling as the market sold off in March, and once the Liberation Day tariffs came out, it got hit even harder. Because you better believe these jeans aren't made in America. The stock ultimately bottomed around $50, down 48% from its all-time high set just 2 months prior. Hey, since then, Kontoor's worked its way back to the mid-60s on a series of positive developments, and I think it is time to jump on the bandwagon. Bye. First, given that the real breakdown for the stock started with the disappointing quarter guidance in February, it was encouraging when Kontoor reported a healthy quarter in early May, a tiny revenue miss paired with solid earnings beat. More important, management raised their full-year forecast pretty significantly. Of course, the business didn't turn on a dime. They raised their forecast because of that brilliant Helly Hansen acquisition. Kontoor said specifically that Helly Hansen, a storied Norwegian rugged outdoor brand, will contribute 16% of growth and 20 cents of adjusted earnings, which is exactly the amount that they raised the guidance. They also didn't include the impact of the tariffs, which could represent a $50 million hit. But look, when Kontoor reported in February and the stock melted down, Wall Street was expecting them to earn $5.37 per share for the full year, and they disappointed by guiding for $5.20 to $5.30. By the time the company reported again in early May, the full-year forecast had come down to $4.88 per share. So the new raised forecast of $5.40 to $5.50 per share was a major upside surprise. The next sign that we got was about a month ago, in early June, when analysts at Goldman Sachs reinstated coverage of Kontoor with a buy rating and an $85 price target. The Goldman analysts were excited, like me, about that Helly Hansen acquisition. They also cited healthy underlying trends in the base business, a significant growth optionality as Kontoor integrates the Helly Hansen brand, and Kontoor's relatively attractive positioning as a result of current tariff policy. It was a very bullish piece. A couple weeks later, I went on vacation with my kids to British Columbia. And despite it being the middle of summer, it can really get cold there. Holy cow. Especially when you're hiking in the mountains like we like to do, or you're doing some fly fishing. So what did we do? Well, we got some Helly R outerwear, as we call it. And I got to tell you, it was really great, especially those raincoats. No wonder they say it's trusted by skiers, sailors, hikers, and professionals with outdoor jobs. HH, as it is known, is stylishly indestructible. Okay, anecdotal? Sure. But the experience jogged my memory on why I liked the story so much in the first place. When I spoke to CEO Scott Baxter back in February, he explained the rationale for the deal, saying that Kontoor was adding Helly Hansen to kickstart a new growth year after spending the last couple of years on really cutting costs, improving efficiency. The company wanted to expand into outerwear or workwear, and this deal gave them both. It also boosts their exposure to Europe and Asia. More importantly, Kontoor believes that there's the infrastructure in place to grow this new business significantly from its current level. I believe that, particularly here in the United States, which represents less than a quarter of Helly Hansen's current sales. As Baxter put it, it's a $650 million business, and there's no reason it can't be a billion-dollar business in our portfolio. And I believe him. Finally, on last night's show, we heard two things that are very positive for Kontoor. First, Levi Strauss, another big denim play, reported a blowout quarter that sent its stock up over 11% today, despite a fairly ugly day. That gives me the confidence in the whole category of denim, including Kontoor. Second, we heard from this outfit called 100X, an alternative data firm that collects information on what consumers actually plan on buying. In last night's chat with 100X CEO Rob Pace, he mentioned a group that they've dubbed the MVPs, which stands for more value for the price. And that group includes Kontoor, especially the Wrangler brand. And giving consumers real value is how you win in this environment. Hey, by the way, go check the Wrangler stuff on Amazon tonight. You won't believe it. When I hit it up, I couldn't believe it. Wow, they've got some incredible values and terrific outerwear. I am not a paid spokesperson for Contour. But wow, I bought a ton of stuff from that all had Wrangler on it. And look, when you consider the fundamentals, well, there's really a lot to like here. Even after the stock's recovered a bit from its April lows, it's still only back to the high 60s today, down 30% from its early 2025 highs, and essentially back at the same level where it was trading a year ago. Contour stock remains very cheap. It's just trading at just over 12 times the midpoint of the new earnings forecast. Also supports a generous 3% plus dividend yield. Even if you're worried about the tariffs and want to give that earnings forecast a bit of a haircut, say a 15% haircut, then the stocks would still be trading at less than 15 times this year's earnings estimates, much, much cheaper than the average name in the S&P 500. Here's the bottom line. I've been feeling better and better about Contour Brands for a while now, and after last night's deluge of good news and the acquisition of Helly, I say we should stop thinking about it and just buy the darn stock already. Buy! Let's go to Steve in Kansas. Steve.
Yeah. Hey, Jim. Thanks so much for taking my call. I'm really a big fan.
All right. Let's go to work. What do you got?
Well, I became familiar with Dutch Brothers a few years ago, and I think they're a fantastic company. I bought the stock on the dip last April. And that stock, of course, has been dropping a little bit for the past few weeks, but I'm still in good shape. I know that they source their beans from Brazil and other South American countries. So with the current tariff issues going on, I'd like to know your take on this situation. Should I buy more since it's down, or should I take some money off the table or just hold?
Let's do this. Let's hold. It's a very small part of whatever cost they have. Dutch Bros is in major expansion mode. You know, I think it's terrific. I've had Christine Barone on the show many, many times. Know the brand from when my daughter lived in Oregon. And I feel like the stock at 63, not necessarily a great level. I would wait till it comes down a little, perhaps when it reports. There might be some sellers. They don't report till August. Don't be in a hurry. You have a nice gain. No need to add more stock right here. Let's go to Nassim in Florida. Nassim.
Hey, Jim. Booyah. Huge fan. Love your show.
Thank you, buddy. What's up?
This stock I'm calling about got to 150 at its peak and suddenly went down to 80s and 90s this year. I want to know why this stock is falling so hard and what you think in the short and long term. The stock is Kava.
Okay, it mystifies me that the stock's been down so much because, I think it's terrific. I would say, just so you know, that I feel very good at this thing down at 90. But what the problem is this. It sells it. It's got 150 multiple, and people just say, you know what? I don't care how great they are. I'm not paying for that. I say just hold it, and if it breaks down, buy some more because I think this brand is going to be in for the long term. I like it, and all I can tell you is it is kind of stunning that it fell from 172 all the way down here. All right, the Contour brand story has been intriguing for a long time, and with the positive signs we've seen in the past few months, I think you can step in right now and buy the stock at these levels. Now, much more Mad Money. We took some amazing questions from Investing Club members at our annual meeting early today, and tonight we want to make sure we got to any that we may have missed, and I know we did, so everyone can get an inside look at what we do for the Investing Club. Then I'll reveal one name I'm having some sellers remorse about. Yeah, I'm kicking myself, and why I think now could be the right time to get back into the stock. It might help you try to figure out when, if you sell something, you should get back in. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Earlier today, we held our CNBC Investing Club annual meeting. Jeff, Marks, and I got together to walk club members through our decision-making process in person for the portfolio. We discussed our current holdings, and then we took some questions from our club members. And this afternoon, the entire Investing Club team got to ring the closing bell right here at the New York Stock Exchange, which never fails to take my breath away, no matter how many times in years I come here. My favorite part of the meetings is always taking your questions. And since we never have time to take them all, we're going to give you an inside look at what happens in these meetings, while also hopefully doling out some much-needed market advice. So let's start with William in California, who asked, "Hi, Jim and Jeff. I'm a founding member, thank you, and very much appreciate your mentorship being a construction guy. My question is, when trading around a core position, Amazon, I sold 50% for a profit, but it never got to my cost basis. I believe it will continue up after the pullback. Can I add over my cost basis?" All right, now, typically, I don't advise that. The reason I don't is I don't want to be in a situation where it's just animal spirits enthusiasm making you want to buy something. I like to have a catalyst. I don't like to just wake up one day and say, you know what? It's time to buy more Amazon because I think it's going up. If you have a reason, if you think you want to be in ahead of something, if you think that there's something that's changed that makes it so that you've got to have more Amazon, you have my blessing. But if you're just waking up and saying, darn it all, I wish I hadn't sold on Amazon, let me get some back, that is a problem. And it's a problem that I actually am going to address in tonight's show because I've got a stock that's like that. If I think it's going higher, I buy it. Next up, a question, if I have catalyst. Next up, a question from Scott, who asks, I'm a club member, but missed getting into the energy infrastructure play. Can I take positions on Eaton or GE Vernova at the current levels? Okay, we advise that GE Vernova is the one that's going to have the longer runway. But because it's such a wild trader, 52-week high today, because it's such a wild trader, we advise that you don't buy all at once. So let's say you want to buy 10 shares, because it is, it's a $600 stock. If you want to buy 10 shares, just buy 2 or 3. And remember, there's no commission, so it doesn't matter. In the old days, it used to be a big commission if you tried to do that. But I do want you in it. I would use, with a stock like that, I would probably use 25-point incrementals. So I do 25 by 2, and then wait 25, then 2, and then wait 25, then 2, wait 25, and then we take a look at it again and see, but it might be my last 25, get a decent average. Yet it's very hard to trade these stocks that are so big. I always try to get managements to do a split. I know it doesn't create any value, but it certainly makes it a little less intimidating to do that kind of buying. Next up, Janet in Florida asks, I'm curious to know what you think Robinhood will do in the long run. I have a big position. I'm holding on to it. I want you to take out your cost basis. It's had a major move. Robinhood has become what I call a meme stock. It means that it's just trading off of enthusiasm right now. When I see trading off enthusiasm, what's the matter with that? Well, enthusiasm can cool. I like trading off of fundamentals. Now, Robinhood is doing well, but they have really, let's say, become very big cheerleaders for themselves. Nothing the matter with that. But don't get caught up in the hype. Take your cost basis out, and then we can deal with, let's say, a letting it run situation, but not until then. Now, let's go to Neil in Washington, who asks, Jim, I have several stocks where I was able to sell half and recover my cost basis. Do you recommend further trimming as shares dramatically climb, or simply let them ride? Okay, this is the NVIDIA issue. And the answer is, let it ride, because you can never lose money. And that's what I call playing with the house. You must take that cost basis out, and then you can just let it run. And who knows how rich you're going to get. Isn't it terrific? And you'll never lose. Next up, William in New Jersey asks, what is your current evaluation of Chipotle? It's been flattered down for a long period of time. Do you think that it's worth waiting for earnings later this month to sell? Okay, why to sell? Right, he's a good CEO. I think that a lot of people feel right now that the price that it's gotten, the meals are too expensive. I think that's nonsense. What's really happened here is they did this 50-for-1 split, and there's just stocks sloshing around everywhere. It just hasn't been able to put together 2 good quarters. When it does that, I think it can break out again. But it's not. We don't own it. When it comes to restaurants, I like Texas Roadhouse. Why? Because it's a regional and national story. I prefer that to the stock of Chipotle. Now let's go to Christopher in Georgia, who asks, hey, Jim and team, I got a dilemma in this market. I've got 10 individual stocks. They are all positive for me. Should I violate my cost basis to add to one of my 10 stocks, or should I find an 11 stock? Thank you all for all the interesting and fun content. All right, once again, I come back to this notion. Catalyst, and do you like it? In other words, of those 10 stocks, which one has something that's about to change that might make it so that you can justify coming in and buying more because there's going to be a step function? For instance, we have Capital One. Capital One's a good stock, but once that merger came together with Discover, well, that's a catalyst, and the stock went down, and that was just, even though it's above the basis, just got to go buy. You need to look not at the basis. You can even white out the basis if it helps you to get outside yourself. But you have to think, is there a catalyst, and why buy now? Maybe the market's really oversold and you're looking to add something. You don't just add an 11th because of the rule about not filing your basis. I don't want you to be a mutual fund. You become a mutual fund when you start getting more positions. So let's just be wary that we don't want to have too many positions, and we do want to be bigger in the stocks we really like. Next, we have a question from Rich in Texas, who asks, booyah, Jim, booyah. With all the uncertainty around tariffs, is it safe to start a long-term position in Prologis first, or should we wait for a significant pullback? The CEO of Prologis is being changed. I love Mogadine. He's terrific. I am not as keen on the warehouse market right now. I think that I think you have too much space in it. And I don't think that they're going to put up as many as before. But if I got a price break, if I got it down to here, I would take action. But right now, I'm not. I've got other stocks I like more. I don't feel that I need to take a position in Prologis. Great company. I just don't feel I need that position. Now, thank you for all your questions, and thank you to all our club members. Mad Money is back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the lightning round. We're also on the same stocks out of buy, sell, jumping to the cold hundreds. Everyone have a step business, grab it, play to sale. And then the lightning round is over. Are you ready, Skinny Dad? Time for the lightning round. Let's start with Tom in Florida. Tom.
Hey, Jim. Thanks for taking my call.
I'm
hey,
getting during the show, Tom.
I'm a great. Can you hear me?
You betcha.
Yeah, I'm a great believer. I'm a great believer in your idea that it's an ideas-driven market here more than ever. And the ideas that I like, one of the ideas I like is defense industry stocks. But a lot of them had a big run-up lately with the big beautiful bill and so on, and the spending of the European military defense spending. But the one I'm looking at, I said I don't want to buy the ETF. Huntington Ingalls and Street.
I've liked it since it was spun off by Litton. I think it's terrific. It's the absolute best play for us to be able to build our ships, and we need a better Navy. I think it's a buy. Let's go to Tim in California. Tim.
Booyah, Jim. Happy Friday, buddy.
Same to you, partner. What's up?
Hey, I'm super excited about a stock, and I'd like to hear what your thoughts are on Rocket Lab.
Oh, man, this is one of the hottest stocks in the universe. This is one of the stocks where I remember I changed my mind. I said, look, if there can be an article that moves a stock up 10%, 15%, I'm going to recommend it. This Rocket Lab has been right now for the last 10 points. It's going to continue to be right. What can I say? I say, buy. Let's go to Alex in New Jersey. Alex.
Hey, Jim. Happy Friday.
Same, right back at you. What's up?
My name is Alex. I'm calling in from Princeton. My dad and I watch your show all the time. We love it.
Tell him I said hi.
I will. Listen, the stock I'm calling in about is TSSI. They've had
That's a pretender. We want to be in CoreWeave if we're going to go there. We don't buy number 2. We buy number 1. Let's go to Joe in Florida. Joe.
Jim.
Joe.
I need your guidance on a club stock favorite and one I hold a position in, Eli Lilly.
All right, listen to me. This one is one that everyone's going to give up on. Then one day it's going to be up 300. I'm not kidding. That's what happens with these stocks. This stock went from 200 to 600, then went to 900, then came back to 700, then went up to 800. This thing is just a coiled spring when we get the new numbers. But don't be too excited. There are many big studies coming down the pike. A hypertension study that's going to be remarkable. There's going to be heart failure, and there's going to be Alzheimer's study. How can you leave this one right here? I see plenty of people losing it, and they shouldn't. Let's go to Brandon in Texas. Brandon.
Booyah, JC. Looking
Booyah,
to see about
Chief.
that CAG.
Very tough situation. ConAgra's got 7% inflation. They got a problem with tin cans. They can't. It's killing them in terms of roll costs. The margins aren't that good. The brands aren't enabling them to be able to take any price. I have to tell you, the one thing that was important was that on the conference call, they did say that they think they have no problem paying the dividend. A company that has to answer about whether it has a problem paying the dividend or not is a company that I say, don't buy. Let's go to Bob in Arizona. Bob.
Hello, Mr. Cramer, longtime fan, first-time caller. I'm curious about your opinion on NXPI.
Oh my God! See, we got a Texas Instruments upgrade today. We got an Analog Devices upgrade earlier this week. NXPI is the last of the Internet of Things semiconductor company with a lot of auto, and auto looks good to me. I think you buy NXPI on Monday morning. I do not kid you. Monday morning, we're going to take a shot at that one. Let's go to Scott in Florida. Scott.
Hey, Jim, club member here. Love your show and analysis.
I wish you were with us today. That's right.
Do too.
All right.
I'm into Power Solutions, PSIS.
Then you're a winner. What can I say? That is an amazing stock. It's not even that expensive. Look, I was so busy with Caterpillar, I didn't get to the Power Solutions. You're right. Keep on it. Terrific work. Good homework. Obvious club member. Thank you very much. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, when is it time to get back into a stock after selling? Cramer's giving you his thought process behind his sale of Alphabet for the charitable trust. Next.
Booyah, Jim! I love you, man. I've been watching you from day one.
Thank you for all the wonderful advice that you provide us.
I'm learning so much watching your show. Watch your program every day. I love it.
Always wanted to say booyah on your show.
Thank you for being the greatest in the world.
We consider you the money market maker, and we thank you for all you do.
I love your show.
We're longtime fans of your show, and we think it's the most entertaining program on TV.
What do you do when you sold a stock that, in retrospect, you think you should have held on to? That's one of the things I've been beating myself up around in front of club members who came in today. I'm remonstrating about the charitable trust sale of Alphabet, a long-standing position and a very big win that we sold. Why'd I sell it? Well, first, I can tell you that my idea for selling it was a bad one. I made a mistake, but one that could have been made by anybody. It centered on a big win by the Justice Department against Alphabet, where a federal judge deemed the company a monopolist. Why was that a mistake? Who wants to own a company that's been deemed a monopolist? Well, because the legal remedy for a company that's a monopolist is simple. The court will most likely break up the business if it gets its way. But if you believe that Alphabet's parts are worth more than the whole, that's not a problem. You'll get Google Search, the Android operating system used by 3.5 billion people, YouTube, the most watched streaming platform in the world, Gemini, that's its new AI system, and Waymo, its self-driving car business that I like very much. Now, initially, I had some seller's remorse because the stock went straight up without me, as others weren't as chagrined as I was about the monopolist charge. Maybe they figured out the sum of the parts story fast and decided it was worth well in excess of the company's then market capitalization, just under $2 trillion. About a month later, though, the stock got clocked when Apple's Eddie Q, testifying in one of the myriad suits brought by the government, said that in April, Google searches conducted by Apple Safari fell for the first time in 20 years. Google does about $200 billion in search. If it's slowing, there's no way that Gemini can make it up. Vindication, right? No, the stock got dinged for a couple of days, then it came right back up and exceeded where it was. That bugged me for certain. I take this stuff so personally. Then last night, we had Rob Pace on the show. Rob's the founder and CEO of an outfit called 100X, which collects feedback on thousands of brands directly from customers. Talked about them when it came to Contour. I find their information really, it's invaluable. Rob had just gotten some interesting data about Waymo. A large number of surveyors said that they felt safe about driving in a Waymo, almost as much as they do it in a typical Uber or Lyft. In some categories, like cleanliness and vehicle quality, Waymo already passed those competitors. More important, Rob told us that the future usage figures are up huge from last year, meaning that people are increasingly planning to use Waymo. It's had a very big move in people's minds. All right, so let's see. Right now, Tesla's valued at about $1 trillion. I think that roughly half of that might be because people are betting on their self-driving technology. Waymo is well ahead of Tesla right now in terms of regulatory approval. So who knows what Alphabet might be worth if the government moves to break up the company. Plus, if we discover that Google can regain its status as an important place to look things up, then that $2 trillion market cap, it could be way too small. In other words, it's time to get back into Alphabet. But where? When I want to get back into a stock that I've already sold, I don't try to outthink it. I don't want to look at where I bought it before. I don't want to be a prisoner of where I sold it. But I also just don't want to go in there and just buy it because I say, oh, darn, I got to get in this one. We're now nowhere near the time where the court order breakup might occur. Nevertheless, what matters isn't that I sold Alphabet. What matters is where I think it is going. And ultimately, the answer is I like to say there's always a bull market somewhere. I promise I'll find just for you right here on Mad Money. I'm Jim Cramer. See you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.